At 47, Tom receives a $640 repair estimate for the truck that gets him to work. He has $300 in cash, so $340 goes onto a credit card already carrying a balance. The repair does not become smaller, it becomes debt. That is what restarting a financial life with almost no accessible buffer can look like. Not a blank spreadsheet, not zero responsibility, zero room between one necessary surprise and the next required payment. This is not proof that Tom is irresponsible. It is not proof that he failed because he is 47. And it is not a story about giving up every small pleasure. It is a story about a recovery system that lets due dates, emergencies, and the next available dollar move through separate queues. That mechanism has a name: the zero buffer tax. It is not a government levy. It is not the $640 repair bill itself. It is the pressure created when an unavoidable shock has no cash lane and is automatically converted into expensive debt. Tom is a fictional composite. He is a logistics coordinator at a packaging distributor in Dayton, Ohio. His income has stabilized after a difficult interruption. He earns $63,000 per year. His model take-home is $3,900 per month after payroll deductions. His tracked monthly outflow is $3,420. That includes $1,400 for housing and utilities, $640 for food and household needs, $610 for the truck payment, fuel, and insurance, $180 for a medical payment plan, $170 for phone and internet, and a scheduled $420 credit card payment. That leaves a modeled margin of $480 per month. Before the repair, Tom has $300 in cash, $9,000 in retirement savings, a truck with a tracked current value of $8,000, $18,600 on a card charging 25.99%, an $11,000 vehicle loan at 7.9%, and a $4,200 medical payment plan at 0% under his fictional current agreement. His current retirement contribution is zero. His narrow-tracked position before the repair is negative $16,500, $300 cash, plus $9,000 retirement, plus $8,000 truck value, minus $18,600 car debt, minus $11,000 vehicle debt, minus $4,200 medical debt. That is not Tom's complete net worth. It excludes every asset, obligation, tax, benefit, and contract term not listed. The take-home number is a model, not a payroll calculation for another household. Then the $640 repair arrives. Tom uses all $300 of cash. The remaining $340 goes on the card. Cash becomes zero. The card becomes $18,940. The narrow-tracked position becomes negative $17,140. The position declined by exactly the direct $640 repair cost. We will not add that repair to card interest and then add hypothetical future investment growth to invent one giant tax invoice. Those are different measures on different clocks. The zero buffer tax is the name of the mechanism, not a claim that a separate $640 fee was taken from Tom. That mechanism has three parts. The first is the due date collision. When cash is tight, every bill speaks in the same language. Pay me now. But the consequences are not the same. Housing protects shelter. Utilities protect basic function. Transportation and insurance may protect the ability to earn. Court-ordered obligations can carry legal consequences. Creditors and service providers operate under different contracts. A calendar sorted only by the loudest notice can hide those differences. The Consumer Financial Protection Bureau's current prioritizing bills tool tells consumers to weigh the consequences, protect housing and income, keep insurance, and meet court-ordered obligations. It also says not to ignore a bill that cannot be paid. Contact the person or company owed and explain the situation. That does not guarantee a fee waiver, a new due date, forbearance, or a payment plan. It creates a documented question instead of a silent assumption. The second mechanism is the shock to debt loop. The repair is unexpected, necessary, and urgent. Tom needs the truck to keep reaching work. Without accessible cash, the card becomes the emergency fund. The CFPB's Emergency Savings Guide describes this exact risk. Even a minor financial shock can create a lasting setback when it becomes debt. The guide does not say every household needs the same starting number. It says the amount depends on the situation and that even a small reserve can provide some protection. The problem is not the existence of one repair. The problem is that the next repair can enter the same card before the first one has left. The third mechanism is the recovery root gap. Tom's income is moving again. He has $480 of monthly margin, but that margin has no written sequence. 1 month it covers an old bill. Another month it stays in checking. Another month a surprise absorbs it. The card receives $420 because that is the scheduled number. Retirement receives 0 because the recovery never reached that page. Available money is not yet routed money. Now comes the turn. In Warren Buffett's 2018 Berkshire shareholder letter, he wrote that sensible people do not risk what they have and need for what they do not have and do not need. That sentence is not a payoff formula for Tom. Buffett's resources and choices are not comparable to Tom's. The useful boundary is narrower. Do not put the truck needed for work, the cash needed for the next shock, or required household payments at risk in a desperate attempt to make the recovery faster. Tom does not need a heroic bet. He needs a sequence. The first blocker is the priority triage board. Tom puts every essential expense, debt, due date, interest rate, contract term, and consequence on one page. The top lane protects housing, utilities, income-producing transportation, required insurance, and legal obligations. The next lane contains the payments required by current agreements. Any payment Tom may not be able to make moves into contact lane before the due date. Who was called? When? What option was offered? What was declined? What did the written confirmation say? The board does not erase an obligation. It prevents the loudest collector, the easiest autopay, or the most frightening envelope from silently deciding the order. Tom checks the medical plan's actual 0% terms instead of assuming the rate can never change. He checks the card statement instead of assuming every balance category has the same annual percentage rate. He checks whether moving a due date changes any fee, grace period, or reporting term. Every result goes in writing. The priority triage board blocks the due date collision because payment order is based on documented consequence, not noise. The second blocker is the starter buffer gate. Tom chooses $1,000 as his first reserve checkpoint. That is his personal starting number for this illustration. It is not a universal emergency fund recommendation. He keeps making the scheduled $420 card payment. For months 1 and 2, the $480 margin goes to the reserve. The reserve reaches $960. In month 3, the first $40 completes the $1,000 gate. The remaining $440 joins the scheduled card payment. That month's total card payment becomes $860. From month 4 forward, the scheduled $420 and the $480 margin combine into $900 per month. The reserve is not proof against every emergency. It is a cash lane designed to stop the next small shock from automatically entering the card. The third blocker is the next dollar sequence. Now the card model can be tested without pretending it is a promise. The starting model balance is $18,940. The annual percentage rate remains fixed at 25.99%. There are no new charges, no added fees, and payments occur at the end of each modeled month. Interest compounds monthly in the illustration. Actual issuers may calculate interest daily using average daily balances, so Tom must use his real statement for a real payoff date. In the simplified model, the first month's interest is about $410.21. The scheduled $420 payment reduces principal by only about $9.79. That is the system pressure made visible. Investor.gov says eliminating high interest debt generally beats trying to earn a matching investment return with the same additional dollar. That is why Tom's next dollar sequence targets the card after protecting current essentials and completing the starter gate. Under the stated assumptions, the card reaches 0 in month 31. The final modeled payment is about $393.52. Total modeled interest is about $7,453.52. That interest is a model result. It is not added to the repair and not added to a future value difference to manufacture a sensational loss total. It can change if Tom's rate, fees, timing, new charges, or payments change. Tom also avoids a dangerous shortcut. He does not deliberately stop required payments because a debt settlement advertisement promises a discount. The Federal Trade Commission warns that stopping payments can allow fees and interest to grow, damage credit, and expose a consumer to collection or a lawsuit. A creditor is not required to accept a settlement, and forgiven debt can have tax consequences. If Tom needs specialized help, he verifies the provider and the terms instead of buying a guarantee. Month 31 is not the finish line, it is the routing handoff. The $900 that had been serving the card now receives 3 jobs. $650 per month goes to modeled retirement funding. $150 per month expands the emergency reserve. $100 per month protects planned flexibility. The total remains $900. Tom must still verify whether he has a workplace plan, an employer match, vesting rules, Investment choices, fees, eligibility, and tax treatment. $650 per month is $7,800 per year. That is below the general 2026 employee contribution limit for a 401k plan, but a federal limit does not create plan access or to make a contribution suitable. Now test the 20-year runway to age 67. The Social Security Administration lists 67 as full retirement age for people born in 1960 or later. That does not tell Tom when to claim or how much he will receive. It gives this illustration one planning marker. Tom begins with $9,000 in retirement savings. The baseline holds monthly contributions at zero for all 240 months. At a fixed 5% annual return with monthly compounding, the modeled balance becomes about $24,414. At a fixed 7%, it becomes about $36,349. The action path contributes zero during the 31-month card model, then contributes $650 for the remaining 209 months. At 5%, the modeled balance becomes about $240,409. At 7%, it becomes about $300,702. The modeled differences are about $215,995 at 5% and $264,353 at 7%. Those differences are not money currently missing from Tom's account. They are separate nominal scenarios built from fixed assumptions. They are before fees and taxes. Market returns are not guaranteed. Contributions can be interrupted. Inflation changes purchasing power. The model does not include Social Security, an employer match, changing income, changing expenses, or a retirement spending target. It does not prove retirement adequacy. It shows what a written X dollar route can change under two transparent assumptions. The relief is not that Tom found a secret way to become rich. The relief is that one surprise no longer gets to control every financial clock. The Priority Triage Board protects what keeps life and income functioning. The starter buffer gate gives the next urgent expense a cash lane. The next dollar sequence tells the monthly margin where to go before pressure assigns it somewhere else. Pressure becomes analysis. Analysis becomes a route. And the route can be reviewed whenever income, rates, bills, or life change. If you are between 38 and 52 and feel as if you are restarting from zero, begin with the real meaning of zero. Zero cash, zero monthly margin, zero retirement contribution, or zero written order for the next dollar. Those are different problems. Write the ledger. Rank the consequences. Choose a starter gate that fits your risks. Test a high-interest debt route with your actual statement. Then give the release payment a future job before it disappears. You are not behind because a repair happened. You are not disqualified because the runway is shorter than it used to be. The goal is not a perfect restart. It is a recovery system that one unnecessary shock cannot erase. And in the next Hidden Tax, we will examine what happens when a raise improves the present but never reaches the future.